Hello, everyone. Thanks so much for being here. We have one of our preferred guests today, Kevin Luthringhausen. He's the head of business development of Trader Inc. For those who do not know, Trader Inc. is PipTrade's partner, and it's most of the technology you use with for trading in our platform is powered by Trader, and TradeHawk is part of Trader and is one of the best tools in the market for options trading. Today we will be talking about strategies to win with volatility, and I always ask this question and I never remember. Thanks so much, Kevin. Lex, for being here. And my question was, how years have you been trading?
So I've been trading. I know this is going to tell you how old I am. I've been trading for 33 years.
Okay, so you're starting at 5 years.
Oh, wow. 33 years. Oh, my gosh.
So thanks so much for being here. It's always a pleasure, and we learn a lot from you.
Great. Happy to be here. Thank you. All right. So we're going to talk about volatility a little bit, right?
How would you play volatility with options, and what do you think are the best strategies and
in these volatile times?
Yeah, uncertainty. And
is it okay if I go over, how we look at implied volatility and actual, give a little brief summary of that?
Yeah.
Okay.
Take it.
I don't want to get, what I would try not to do is get too mathematical, and I'll try to speak as slowly as I can. I tend to speak fast because in the trading world, you do everything fast, right? So.
Right.
Okay, so first of all, what we're looking at is my TradeHawk layout. Okay, and you know what? I can use annotations, right? I think I can draw.
You can draw on your side. Let me.
Yeah, I don't see it on here, Joe. It would be helpful if I could draw some stuff.
Give me 1 second, because I disabled that because we had spammers. But give me 1 second, and you can start, and I'll make sure you can have that.
Okay. All right. So when you give me that drawing tool, I'll point it. But what you're seeing, everyone on the screen, is my trading layout. Okay. And you first have to start there. So I just know that this can all be moved around and what have you. But on the left side, where if you can see my mouse, is my option chain. So that's where all the options are in this particular stock. And I'm looking at spiders right now. So I figured spiders would be a pretty good example, since it's kind of market-based, right? The spiders, as opposed to an individual stock. So what I did is I typed in here SPY. There's drop downs as well to get spiders. So it's down there, right there. And it pulls up all the options. So each expiration has an implied volatility to it. What does that mean? It means that the option prices in the marketplace are telling you a story about what traders think volatility is going to be like in that underlying instrument. Okay. And Juan, I don't know how you want to handle questions, but if you want to interject questions, please feel free. If you don't understand something I may have said, okay?
Sure. You can now draw, I think.
Okay. I can't, it usually says annotation. I don't see it on the choices for some reason. Why is that?
Just put it annotation.
Yeah, it's usually a choice. I'm not seeing it anywhere as a choice. That's all right. Should I reshare?
I suppose you can, yeah.
Let me do that. Okay. No. All right. Well, we'll go without it. No biggie. Okay. So yeah, go ahead, Juan, and just feel free to jump in if I don't explain it well, or you need more clarification. That's perfect. And I have the chat up too, so I can see if there's questions. Okay, so back to implied volatility. So we as traders, that's a super important feature. We're always known in the professional side of the business as being volatility traders. And what that generally means is that, like anything else in the trading business or in any business, you always want to buy things that are cheap and sell things that are expensive. So all options have that kind of characteristic, right? And if you're following the markets now, the markets now are very volatile. What does that mean? That means that they have very, very wide ranges intraday, and they can have very, very large ranges overnight. So you've seen in the morning when you come in and the market's down 900 points. Okay, that's a big, big jump. So you can't price options based on something, right? Because options are derivatives that moves a lot and not have some safety built in. Okay, and I always like to use analogies and pictures about implied volatility. So I hope you can understand this. If I'm in the insurance business, okay, and I'm an insurer, and I sell you insurance, and let's just say it's hurricane insurance, and that means that, if a hurricane comes and your house blows down, I got to pay you. I'm certainly not going to sell you a cheap insurance policy if the hurricane is right out on the shore and it's about to hit your house and give you insurance for $5,000, right? Options are very much like that. They're insurance policies, right? So people and traders aren't going to sell you something that's really, really cheap when the hurricane is bearing down. And the analogy is, in our environment now, there's things going crazy. There's news events, there's political unrest, there's all kinds of things going on. So the hurricane can hit any time. So naturally, the insurance is much higher. And that's what implied volatility is all about. So if you look at my screen, you can see I'm up top here on this June 26, 2020. This implied volatility in spiders of 32.9, it's actually very high, okay? It's very high. So if you go to, we have an implied volatility graph, okay? And we compare actual volatility to implied. So you can see that implied volatility over here is pretty high over the year-long average, okay? So it's up there. And you can see this is about when coronavirus hit, and you can see this massive spike in volatility. So the red is the actual underlying spider, and the white is the implied volatility of a 30-day option. So this implied volatility naturally had to go up because the hurricane was hitting, right? A lot of craziness out there. So prices went up. And now you see as things subside in the market and with the coronavirus, the implieds come down, but still not to the lowest level it could be. It's spider volatility technically is around a 12-ish, I'd say on average, maybe a little higher for 30-day options. Okay, so that's what this is saying, right? The other example I like to use, if you're up in an office building and you look outside and you want to know what the weather's like, what do you notice of all the people walking down below, right? You notice what they're wearing. If everyone's walking in heavy winter coats and hats and gloves, it's implying that the temperature is very cold out, right? It's chilly. Conversely, if they're all walking around in bathing suits and no gloves, it's implying that it's very warm. Well, the option market does the same thing. That's what those numbers mean to the option traders, that implied volatility. So what we try to avoid is buying high volatility and selling low volatility, okay? So Juan, your original question, what do you do in times like this, right? And I don't know if anyone can type an idea, but I just put in a long straddle, okay? So what does a long straddle mean? That means I'm buying a call and buying a put of the same strike, and note that I'm buying it, okay? So when I buy something like that, that strategy gives us what we call curvature or gamma. And again, I don't want to try to get too mathematical, but notice the risk graph of this strategy. What do you notice? If the price of the underlying security on the x-axis, okay, is going down in this direction and up in this direction, notice that if we go down far enough, we make money. And if we go up far enough, we make money. If we sit here and time goes by, you can see my little green line. Watch my numbers. Time's going by, we're losing money. So options have that trade-off. So if you're buying very, very pricey options like these are, okay, your risk reward profile looks like, hey, if it sits around here, things aren't so good because it decays. Theta works against you in this environment. However, in high volatility environments, we get big movement and we can use our gamma to buy things, buy stuff down here and sell stuff up here. So it puts us in a position of power. But the trade-off is you have to pay for that power. And when you buy high volatility like it is now, your theta, the decaying of your asset, happens with bigger numbers and it happens in bigger components. Okay, so you can lose a lot of money with things just sitting around. Don't forget, strategies of buying long premium and buying things in high volatility environments, while they feel good because they can protect you up and down, they cost you money. What happens on a Friday? You're not allowed to trade on Saturdays and Sundays, but options decay over weekends, and you have no ability to defend yourself with trades and being crafty about managing your position on a Saturday or a Sunday, right? So you get those 3 days of decay at the end of every week. So that's a very big downside in managing that inventory. So if you look at my position, again, I don't have a drawing tool, unfortunately. Look up in the left corner where my arrow is. So this T stands for theta, okay? So this spider position looks like I've got a lot of negative theta, right? That just means that I'm long premium in spiders. I'm long a lot of stuff, okay? And I'm gonna expand this real quick. This is all my spider stuff, right? If you notice, I'm paying about $900 a day to have this position on. That's my insurance premium to gain that gamma, okay? So that's the good news, is that if with big movement, I make money. The bad news is I got to pay $900 to have that right. So that's the kind of the trade-off scenario of using these strategies in high volatility environments to offset that movement. You're going to have to pay for it. Okay. I don't know if anyone has any questions on that. That's kind of a little complicated. I get it, but that is what's going on here. Okay. Juan, does that make any sense?
Yeah, it makes sense because there's no questions, but
okay.
Options have an expiration, so
that's right.
The closer you are to expiration, most of the value is given by time, right? Time value.
That's correct.
Time plus volatility. So less
exactly
time, less value.
Yep. So the other one strategy is the one I showed you, that is the long straddle or long strangle. So a long strangle is, I'm just going to clear this out. So a long strangle is buying a put. Typically it's out of the money put, and buying an out of the money call. So this has the same aspects. So if I send this to that what if screen, you can see that it has the same shape. The numbers are going to be a little different because your kick points are farther out on the strike panel. So you can see it looks similar. It's going to behave. If you move time ahead, you can see that it loses money if it sits around as you move out in time. Okay, so it has that same behavior. It's just that the strikes are separated. So strangles and straddles are similar. Straddles will cost you more money to have. Strangles will cost you less money, but won't give you the same reward. Okay, so these are very viable strategies with volatility. However, the big asterisk or footnote is that it costs you a lot of money to do this. What you're always trying to do as an options trader, at least as a position options trader, is buy cheapness and sell expensiveness. So if you had the ability to look inside of a crystal ball and know that and see something where implied volatility is actually low, okay, and historical volatility is a little low, but on the upswing, that's a great place to buy implied volatility. Even though this particular difference looks great, implied volatility made you money here. The problem is that the implied volatility is at the top of the scale, way up here at 70 something, okay? And the risk here is it's like musical chairs. I don't know if you played that when you were kids. When the music stops, which means in my analogy that when the music stops and this thing stops moving around, if you're caught holding this volatility here and we start moving down here, you're going to lose money all the way down here. So playing high volatility plays, buying this stuff in high volatility markets can work for a while, but just be prepared. You got to get in the chair when the music stops. So you got to really protect yourself. Okay. That's a risk. Another great strategy, especially if you have an idea of where you think stock's going, is using what we call butterflies. Okay. I'm not sure if that's a term you're familiar with, but we call them butterflies. What that is it's a ratio. Okay. And what it is it's in a call side. I'll work on the call side. It's buying 1. Okay. And I'm going to make this a 5-point butterfly, selling 2 in the middle strike. And again, I'm going up 5 strikes and buying 1. So it's a ratio of 1 to 2 to 1. So let's see what that looks over here. So what this does is it takes advantage of high volatility and it protects you from what you can lose by what you pay for the spread. So you can see this spread is only about 75 cents. And your maximum reward is right at that middle strike at expiration. And what you do is you'd make $5 on this spread less what you paid for this. So in this example, $4.25 every time you did it. Now remember, options are times 100, so it's $425 for a risk of $75 every time you do this. When volatility is high and you want to sell premium, which is the opposite of what we just talked about, you can do spreads that take advantage of high premium by creating spreads like butterflies or iron condors, okay? Because those are premium selling type things, all right? And what you hope to have happen here is that the stock trends toward that middle short strike. Now, obviously, the best possible place is right at 310. Now, that's unrealistic. You're going to get out of this thing long before that happens. But as time goes by, and let's look at this. As time goes by with this butterfly, right? And here we are today, and watch the green. We stay right in this middle price here. And I keep moving today. Look what happens to the price of my spread. Notice my P&L keeps increasing, increasing, increasing as time goes by. So what we want to have happen here is we don't have to do, we know what our maximum risk is, okay? It's defined. And we know what our maximum reward is. And we don't have to really manage this too much. We can let this thing kind of sit and let the daily theta do its work. So 2 different examples, one buying premium, one selling premium that can work for you in a high volatile market, okay? One, does that make sense?
Yeah, it makes total sense. So what you were saying, it depends on what's your view on volatility, right? If you think the markets are very, very volatile, you will probably buy a Strangle, right? If you think it's very
but don't forget the risk there, right? The risk is that if you buy that high volatility Strangle, even though the market's volatile, you do run the risk that markets subside and you're stuck holding the bag of high volatility, in which case things aren't moving around and your premium is decaying, getting cheaper and cheaper that you own. That's the risk in that scenario.
Yeah, and sometimes we personally, we get a little bit confused on leveraging and having leverage and volatility. So when you think it's going to go in a certain direction, the market, let's say I'm bearish, which means I think that the markets will go down. I can do that via I can leverage that doing futures, which has nothing to do with volatility, and I can leverage that position. The problem is that when the volatility goes up, it has a mean reversion, right? So volatility, it's always under a certain level, and when we have these spikes, it always tends to go down.
That's right.
So if you want to go and you want to leverage on a directional position, it's better to do it via futures rather than options, because volatility is a big component of options, right?
That's right. That's exactly right. Yep. That's a good point. Yeah. I mean, clearly, if you have an opinion on the market in terms of direction, options, leverage-wise, options are great, right? Because if you're just selling stock, or it's expensive to sell stock, right? You gotta margin that. You can create option spreads and take advantage of the options market, which has tremendously more buying power to it the straight stock and put, you know, the probabilities in your favor, right? And you just mentioned, if you think the market's down, some of the things you can do. Well, in high volatility environments, we can sell call spreads or create credit spreads, bear call spreads, right? So to do that, you're selling a lower strike call and you're buying an upper strike call. Why? Well, we're taking advantage of high premium. So I sold this for $1.60. I can make $1.60, and I can lose the difference between $1.60 and $5. That's my strike difference. But if you're bearish on this thing, this is a great way to take advantage. Two good things can happen, right? This can just sit here, in which case it decays and the 160 starts going into your pocket day by day. The other good thing that can happen is the stock can go down like you thought it would, and this spread will get lower and make you money. The bad thing that can happen is this stock could scream higher, in which case you're stopped out. The most you can lose is the difference between the strikes less your premium. Okay, so that's the bad news. A slight increase toward your strike doesn't necessarily hurt if you can withstand some of the risk parameter there, right? So you can have this thing slightly go up in the wrong direction and still make money. It can go down, in which case you make money, or it can just sit and kind of waft around in the zone and still make money. So there's a lot of good things that can happen from this thing. And these types of credit spreads are with high volatility, high implied volatility, are typically very, very lucrative, and they have a lot of premium value to them. Okay. And the same thing happens on with a butterfly, which is another kind of spread. In high volatility environments, butterflies can be cheaper. So it's kind of nice to be able to do that kind of stuff. And don't forget, butterflies, if you're familiar with butterflies, it's a 1 to 2 to 1 ratio. Long one, short 2 in the middle, long 1 up top. It's protective. There's no reason that this strike has to be exactly the same. You can move it around. The thing that's going to happen is it's going to change your risk profile when you do that, right? Your price may go down, but your risk profile will change on that. You can see what I did by moving that upper strike. I kind of slanted it up a little bit. Okay, so my risk profile changes when you do those kind of things. So if you're using TradeHawk, and I encourage everyone to get a paper trading, it costs you nothing to have a paper trading and use this system for fun and practice. Practice with these spreads. Okay, get your spreads in this thing and hit this little what if button in the middle and send it to our risk simulator and start teaching yourselves what happens to time, okay, and what happens when you get to expiration with these things. And don't be afraid to move these strikes around and see the difference, okay? I do this all the time. I've been doing this forever. I know what this stuff does, but I still do it. It's very, very helpful. So high volatilities to some, you can sell credit spreads. They're usually very juicy. You can do iron condors and long butterflies that will help. Buying long premium can work, but don't forget the risk of long premium at high levels. It can be very dangerous when the music stops, right? And it just starts sitting around, your premium's going to decay. Okay? Juan, how's that all sound? Does that sound good?
Yeah, I just posted the link for TradeHawk on the on the chat. So everyone that wants to learn how options behave, I think the best way to learn it's to practice.
Yeah, absolutely. 100%. So let me just say one thing real quick to everyone. When you get a paper trading account, okay, this is practice. You get a play $100,000 US. Okay, it's virtual money. It's not real. And you can go set up strategies and see how they behave over time. You can actually put these things on. So you would have positions like I have here. Okay, so if you look at my symbol list, Apple and all the way down, you'd have positions. We will keep track of your P&L for you in play money. Okay, so you can practice and you can play all kinds of games and get in and out of trades. You can pretend like you're trading on paper trading. It is very effective. Okay, if you get in this and you struggle, we have all kinds of videos on our YouTube channel that's on that website that Juan just posted. You can set up one of these sessions where I'll do a group of folks and we'll do a tutorial of how to use this system. Now I'm just going through and doing it because I know how to use it, so I'm not really explaining how to do this. But we will teach you how to do that so you can get off and running. There's videos that will do that as well. It's a great tool to learn from. The other thing that's in TradeHawk, okay, is this implied volatility graph. You can look at underlying volatility versus implied volatility and get a feeling of where it has been over the past several years if you want. And so what you get a basis, right? And you can see where it is now. Very helpful to make decisions on buying and selling volatility. Okay, this is the HVOL chart. Okay, so that's all in here as well. Sound good, Juan?
Yeah. I think we actually had a webinar yesterday.
Okay.
In Spanish on what strategies to buy when we expect to have higher volatility.
Okay.
So
what's another one you guys learned about? Do you remember?
So I did a strip strat, but all, strangle, straddle.
Yep.
I didn't cover butterflies. It was kind of basic, but this is, it actually complements it very well because now we're seeing that in action.
Yes, good. Excellent. So here's what I just did an iron condor, okay? So what that is, it's a put credit spread and a call credit spread combined together. So if you don't have an idea of where the stock's going, you think it's just going to be hanging around, this is a great strategy, right? What does this look like? Look at this. Again, nice big zone of profitability from, roughly 303 all the way up to 318, 319. You got nice profitability range here at expiration. So, and you can see the dynamics today. And each day that goes by on these iron condors, look, you keep making money and your range is wider. So if you want to buy a little protection or give yourself a little protection, iron condor, this is called an iron condor. It's a put credit spread, which is a bull spread. It's a call credit spread, which is a bear call spread, combined together in 4 legs, all in the same ratio. This gives you a nice wide area to profit from. Okay.
Yeah, I think what it's great of this tool is, first of all, you can see the difference between implied and historical
Yep.
volatility, and you can also see where the mean reversion is, where generally the volatility is.
Mm-hmm.
So that
Absolutely.
gives you an idea. And you can see in some periods like 2008, when the volatility spiked to over 100 or close to 100, it went down, so it's generally it's momentary, these spikes, and people can profit from that. And
Absolutely.
And the way you show how that your strategy behaves over time, it's a great way to see it. And also you can see you can make simulations on where the price is and how it will move. Absolutely. It's a great tool to learn. And if you're ready, you can actually go and open an account with you as well, right?
Yeah, absolutely. That's done through Trader Your Brokerage, right? They're the broker, and if you want to start doing this live trading, they absolutely, and it's a great product to use. In that we don't charge obviously commissions. We have more of a Netflix style model where you pay a fee per month, and you trade as much as you need. Now for small traders who don't trade a lot, it's probably better to be a per commission version. But for people who trade much more frequently and more options in the course of a month, our Netflix style model is much better.
Yeah, I've posted that on our Pip Trade Academy. So anyone that wants to open an account with Trader, it's in the broker tab. You can see there, and they'll help you to go on. And once you have a Trader account, you can have access to TradeHawk, right?
That's correct.
But it can be real account or practice account, and I definitely
and if you have a real one, you always have access to the paper trading, right? And paper trading, there's no money involved. It's free, so don't worry about that. We don't take any credit card information. It's just you just download it and practice.
So what's your view right now? Do you think the volatility will stay a little bit high, or you think?
Yeah, here's why I think so. I think it's not nearly so high as it was when we peaked, with the corona, right? I think it's due to stay elevated, and it may come down a bit. I think it's due to stay elevated because I think there's still a fear of a spike in the fall with corona, which could cause economic repercussions, right? Businesses closed, that's not good for folks. So there's that fear there. This political issue that's out there. I don't want to say political, but the societal issue that's out there is also problematic to markets. So it puts doubt. Anytime there's fear and doubt in the marketplace, volatility will reflect that, and that's kind of what we have still. If a vaccine comes, right, which everyone knows they're working hard toward, if a vaccine comes, what does that do? I think you probably see a really, really large rally followed by a little bit of a pullback. And then now all of a sudden, when you get day after day of staidness, meaning the market doesn't change a lot, then we start seeing that volatility working its way out of the marketplace, the implied volatility. But until we get that vaccine, we're going to have some interesting times, I think, ahead. So it's going to stay up there, maybe not quite maximum, but up there still. If that makes any sense.
Yeah. And if see that we can have another spike. That's probably an option as well if there's a second wave or whatever, and the economy will close for a little bit, or we have worse than expected results on second Q. We might have another spike, I think, but it will generally tend to mean reversion, right?
Yep, absolutely. That is true. I don't know if the audience remembers the 2008 crisis with the housing in the U.S. That was horrible, and everyone said, "Oh, volatility is never going to go back down to 10 or 12." Well, guess what? It did. It ultimately made its way back down there again in the VIX, and we sat around for a long time, and then we have this new phenomenon with COVID, and we went right back up to what, 70 in the VIX or thereabouts.
Yeah, like 80.
I always say never is a long time, so be careful when you're trading options and say the word never. Anything can happen, right? Juan, can I give a plug to our new option show that we're going to be doing?
Of course.
I'd love to have the folks join us. So what we're going to be doing, and Juan, you're going to be one of our guests. We're going to be doing what we call the Options Brew, and it's going to be once a week, and it's going to be YouTube Live. It'll also have a Zoom component, but it'll be YouTube Live. And we're going to bring guest speakers on to talk about their strategies in the market. So it's going to be educators, and Juan, you're going to come on and I hope talk about peak trade and what you guys do with education. We love that. So we're going to have a variety of people who make their livings in the market talk about how they do it and what they look at. And that's going to be, we think we're going to be doing them on Thursdays every week, in the late morning. It's going to be the Options Brew. So, stay tuned for that. I'll send you an email, Juan. You can pass it along if you want.
So, I'll be posting this on our daily email.
Okay.
And we already had that considered, and you have great speakers, I think.
Yeah, some good ones. Yep.
So if you call me, it'll be a great honor. But
awesome. We would love to. We would love for you to talk about peak trade and all the great things that are going on there. I really love what you're doing for these folks. I think it's awesome.
When you say what you do, I think it's what we're doing, because behind us it's traders.
Well, we appreciate that.
So,
yeah, it's important to us. It's important to us with the college folks to really educate them on options and make them sturdy options traders. That's what keeps them going, right? We want them to really do well on the market. It's a vibrant market. It's really, really wonderful.
Yeah, it's exciting. I can see that. So, all
right.
Manuel says we have very good comments here, and we have a good crowd, I think.
Yeah, we did. Awesome.
It was over 50. Please, more classes about this great platform. Thank you. I'm learning a lot. So it is, people are very excited about looking at this, how to learn and putting the foot on the water and see how cold.
Sure.
What's the minimum unhealthy parameter that we expect in losses in times of COVID?
I'm not sure I understand that one. Juan, you might have to help me there.
Like
is that number of
stop loss, maybe?
Number of deaths? Is that what that one means? Or
Mónica, si quieres en español y lo traduzco porque no entendí bien cuál es el mínimo y the parameter that we expect. Oh, okay, like how much we can expect to lose in COVID times. I think it depends on the market you are, because people are making money right now in COVID.
Oh, yeah. The volatility traders are making lots of money right now.
Yeah.
So, yeah, I mean, so my background, right, Juan, as you said, I was a professional trader. We thrived in chaos, okay? And all that means is that when there's uncertainty in the marketplace, options are the best place to be. So why does that make sense to an options trader? We got to take advantage of mispricings, okay? Things are trading crazily relative to real value, and that's where we were able to capitalize, right, in the options market as professionals. So it works the same way. You just have to know what you're doing. You have to be very careful nowadays, right? Some of the spreads I discussed are very risk averse, but can make you some money. So they're good ways of using high volatility.
Yeah. So the question is like how much we should expect to lose in COVID. You don't need to lose anything, Mónica. It depends. No necesitas perder nada, ¿no? You can even make money.
Right.
That's what. It depends on your position, and if you're risk averse, maybe it's better to have position in cash or something like that. Jimena says, I want to learn more about TradeHawk. It's obvious that it's a professional tool, so I hope I can get deeply in this subject. Yeah, I think everyone learning curves it's how long did it take you to actually get options trading?
Me?
Well, yeah.
Well, I'll tell you what, here's what happened. I started when I was very young, probably around the ages of most of the folks on the webinar. And I failed. I failed my first year, and we had backers back then, and they had to put more money into my account because I couldn't figure it out. And then I finally got what finally happened that put me over the edge is I befriended one of the people in the pits. That's when we had trading pits, and he taught me a lot about trading and about using the kind of spreads that we just went over today. And that's how he made his living. And I learned that. And from that point forward, I never looked back. And it was the education that was really vital and really understanding the dynamics of options and what the real risk reward is. And this tool is great for that. It really is. So that's how I learned.
Okay. So there's another question here. What is the platform that you're using? It's called TradeHawk. I just posted the link. It is here. You can use it. No cost for paper trading. And if you want to go trading, you can start your paper trading account. And then there's another one. There's a couple of more. When we will get back TradeHawk to BitTrade? That's a very good question. We can plug it anytime, but the problem is like we need a little bit more, let's say, more users, so we can split it between options and just stocks, I think.
Yeah. So what's happening behind the scenes internally with us is we're in the process of rebranding of the product, which simply means it's going to have a lot of the same functionality in addition to much more, right? And we're going to change the look and feel of it. And when we do that, it's almost like a rewrite in a way. And we're going to keep in mind the Peep Trade challenge, and we're going to, I'm going to obviously talk to you, and we're going to make it, from the ground up so that we can incorporate it very easily into Peep Trade if we so choose, if you guys so choose, right?
No, that's awesome.
We're going to make it so that it just has that plumbing already built in. So when you do it from the ground up, it's easier to do, as you can imagine, from an existing product. So we have all these. We're really moving along too, and we hope to by the end of this year is to really have the new version fully out. There'll be little versions that come out before then, but we'll have the whole deal. We hope by the end of the year. So it's really, all the new look and feel is really cool. You're gonna love it.
Yeah, and I think the users will do as well. And we can start doing options trading competitions as well,
Yeah, awesome. That'll be great.
So that's the answer to that.
And there's Lex, is there plan to have TradeHawk in Mexico? Juan, do you know, off the top of my head, I don't know, is Trade a Year can take accounts from Mexico? Is that true, or do you?
Yeah, that's what I talked with Dan.
Okay.
So
then the answer is yes.
The answer is yes. Anyone can open an account. Different paperwork, but
there's no account minimums, just so everyone knows. So you can, obviously you can't do a ton of trading with $100 in your account, but you can open an account with any size.
What was the increase on the volatility by the Fed stimulus? Actually, Wilmar, the volatility went lower after the stimulus was announced.
Right. Yeah. Another that pulls out uncertainty, right? And anytime you pull out uncertainty, you get a little retraction of volatility, right?
Yeah. So what is the platform that you're using? Well, I just said it and posted there. When we will have this on Peep Trade, and that was answered as well. Okay. What methods or theories do you recommend to use portfolio management? Well, that's probably another topic, Leonardo. We have that. Tenemos eso en el Peep Trade Academy, es completamente gratuito. Hay análisis técnico fundamental, análisis de portafolio, riesgos. Hay muchísima información ahí. I'm just saying that. Sorry, I'm gonna put this. Oh, I mean next there. Okay. So this is a U.S. company, so they trade on the U.S. markets.
Right.
So that's where we have a lot of information about portfolio management. Not necessarily if you declare that, Gonzalo. How can I identify dropping the action down and buy and opposite when increasing to sell? So like getting some questions here. Mónica, la volatilidad está asociada al riesgo de inversiones. Mientras más volátil es un activo, más violentos son los movimientos de los precios y más inciertas las posiciones futuras en tiempos de COVID futura. Esta volatilidad es mucho mayor. Yeah, so the question is like, of course, given the uncertainty of any given asset,
yep.
The uncertainty, it's synonym, I say, of volatility. I don't know if you agree with that.
No, that makes sense. Go ahead.
So the movements are stronger, so that's also volatility. And in COVID, so right now in commodity volatility is a lot higher. Yeah, and we saw that. If you can show that volatility screen that you shared before,
This
we
one
can
here?
see it graphically. Yeah.
Okay.
So if we look at what's implied volatility, is it the white line?
The white line, and the white line in this case is a 30-day implied volatility, which means it's a 30-day option.
Okay. So
That's what I chose. You can choose anything. There's 60, 30, whatever you want.
So
30 is a good barometer though.
We can see the white line. It is generally before the COVID, it was around 10 to 15, and right now,
yep,
it is like kind of a little bit stable on, not stable, but between 30.
It's like 30. It's 29.34 roughly.
Yeah.
Right? So I just know from experience, Juan, that spider volatility is on average right around there, 12, in the 12s, and it's trading at 30 now. So that's pretty high. That's double, 2.5, right?
Yep.
Times roughly. And look where it got. I mean, that's 75. So, that's a big move, and we're still by no means at a low number. And I can tell you that in the old days, when you got the 30 volatility, that was considered really high.
Mm-hmm.
Right? If you look back over a year, you see here's 30. You don't see a white number above 30 anywhere until COVID came, right? So there is nothing that even remotely resembles it. I can't remember. Can we go back 2 years? Let me see. Yeah. So here you go. Here's a spike here. And if anyone knows what was going on, this is right before Christmas. I don't remember what was going on then. But anyhow, there's a spike in volatility in spiders right there. But look at 2 years ago, nothing really anywhere near 30. And yet we're here now at 30. And that seems really low to us because we were at 75. Right?
Yeah.
So you refer to mean reversion. We're going to get back down to that 12 level sooner or later. Right? And here, look at these numbers here, 9.45, 917. These are really low numbers. That's where it usually hangs out. That's it.
Yeah, so that answers the question. What is the app that what is the app that?
What's that?
Yeah. So the app that we use for trading in PipTrade is Tradier, which is the same as what you're seeing here.
Now you have a different version of it though, right? One in PipTrade?
Yeah. It's a different version, but let's say that the engine is run by Tradier, which runs also TradeHawk. Mm-hmm. So thanks so much, Alex. I know you have a busy agenda right now.
Mm-hmm.
And
got to do another one of these now, Juan. So off to the next one.
Yeah. No, thank you very much. And I'll share this information of the options brew with everyone.
Perfect.
And it's always great to have you here and
thank you.
Learn from you.
Love being here. Thank you very much. I appreciate it, everyone. Have a great weekend, all. Send us an email, Juan, whatever. Get people to communicate with us. We love hearing feedback, and if people want to see certain things or do certain videos, let us know. Happy to do it.
Awesome. Thank you very much.
Okay. Great, Juan. Thank you.
Have a great rest of the day.
Thank you. You too. Bye, everyone.
Bye-bye.
Bye.